It's a special pleasure to meet with this group so soon after the announcement that two of your fellow Harvard alums have been awarded the 2011 prize in economic sciences in memory of Alfred Nobel. I'm referring, of course, to Thomas Sargent, Christopher Sims, and I'd like to begin my remarks by congratulating Tom and Chris on this well-deserved honor. In the 1970s, in independent research, they developed systematic approaches to distinguishing between cause and effect in macroeconomic data. Now, almost 40 years later, their thinking informs the making of macroeconomic policy around the world. I'm especially pleased to acknowledge Chris and Tom's achievement because of their connection to the state of Minnesota. After earning their PhDs in economics at Harvard, where Chris also got his undergrad degree in mathematics, Tom and Chris went on to do much of their prize-winning work right here in Minnesota, right here in Minneapolis, in fact, as professors at the University of Minnesota and consultants at the Federal Reserve Bank of Minneapolis. And I'm sure that many of you in this room have followed that same career path from an education at one of America's oldest colleges to accomplishing great things here in the North Star State. So my remarks today, I'd like to touch on several topics. I'll begin with a quick description of the structure of the Federal Reserve System and the deliberative process of the Federal Open Market Committee, the FOMC. Then I'll describe the FOMC's objectives and discuss how the FOMC makes decisions so as to achieve those objectives. And then I'll close with a discussion of my dissents on recent FOMC decisions that Lauren mentioned. And I'll provide some perspectives on monetary policy going forward. And after that, I'll answer any questions. Before I begin, I should remind you that my comments here today reflect my views alone and not necessarily those of others in the Federal Reserve System, and including my FOMC colleagues. So I'll start with some FOMC basics. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., makes up the Federal Reserve System. Our bank represents the 9th of the 12 Federal Reserve districts, and by area, we're the second largest. Our district includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan, as Lauren mentioned. So 8 times per year, the FOMC meets to set the path of monetary policy over the next 6 to 7 weeks. And all 12 presidents of the various regional Federal Reserve banks, including myself, and the 7 governors of the Federal Reserve Board, including Chairman Ben Bernanke, contribute to these deliberations. Now, I said 7, but currently there are only 5 governors. There are 2 unfilled positions. The committee, the FOMC itself, at any one time consists only of the governors, the president of the Federal Reserve Bank of New York, and a group of 4 other presidents. And that 4 other presidents rotates annually. Right now, it consists of presidents of Minneapolis, Philadelphia, Dallas, and Chicago. Now, I've said that the FOMC meets 8 times per year, but how do these meetings work? At a typical meeting, there are 2 so-called go-rounds, where each president and each governor has the opportunity to speak without interruption, speak in turn without interruption. So the first of these is referred to as the economics go-round. And it's kicked off by a presentation on current economic conditions by Federal Reserve staff economists. Then the presidents and the governors describe their individual views on current economic conditions and their respective outlooks for future economic conditions. The presidents typically start by providing information about their district's local economic performance. We get that information from our research staffs, but also from interactions with business and community leaders in industries and towns from across our districts. So the chairman speaks at the end of the first go-round. He briefly but thoroughly summarizes the preceding 16 perspectives. And I can assure you that this is no easy task. And the chairman's balanced and thoughtful treatment of our remarks is one of the many reasons that he commands such respect among his colleagues. He then goes on to provide his own views about the economy. So that's the first go-round, the economics go-round. The committee then turns to the second go-round, which focuses on policy. And again, it opens with a staff presentation, a presentation of policy options. After that, each of the 17 meeting participants has a chance to speak on what each views is the appropriate policy choice. This set of remarks is followed by a summary by the chairman, in which he lays out what he sees as the committee's consensus view for future policy. The voting members of the FOMC, the the group that I described earlier, the subset of the meeting participants I described earlier, then cast their votes on the policy statement and thereby set monetary policy for the next 6 to 7 weeks. So I hope this brief description of FOMC meeting conveys a couple of things to you. First, the meeting participants view monetary policy as a largely technocratic exercise that is fundamentally apolitical. As I mentioned earlier, our policy discussions are largely based on information gathering and model analyses by meeting participants and their staffs. And I would say the tone of the discussion is pretty much in accord with its rather technical substance. There is disagreement, of course, and I don't think anyone should be surprised by the fact there's disagreement in such challenging and unusual economic times. But as a relative newcomer over the last 2 years, I've been impressed with how the dialogue within the meeting room is always fundamentally grounded in a deep respect for the job at hand and for each other. Second, my description of an FOMC meeting highlights how the FOMC mirrors the federalist structure of our own government. We have representatives from different parts of the country, various presidents, having input into FOMC deliberations. And in turn, I've described how their input relies critically on information received from district residents. And in this way, the Federal Reserve System is deliberately designed to give the residents of Main Street a voice in national monetary policy. So that's how an FOMC meeting works, sort of the tone of the discussion and how the FOMC reaches its decisions. Let me go back up a little bit and then talk about what the FOMC views as its objectives. The FOMC has a dual mandate, which is established by Congress. It's to set monetary policies to promote price stability and maximum employment. Let me talk first about the price stability mandate. And I view the heart of that is to formulate and communicate an objective for inflation. The central bank then fulfills its price stability mandate by making choices over time so as to keep inflation close to that objective. The central bank's job is complicated, of course, by shocks that may lower or raise inflationary pressures. The central bank provides additional monetary accommodation, lowering interest rates, for example, in response to shocks that push down on medium-term inflation. It reduces accommodation in response to the shocks that push up on inflation. By doing that, it works to ensure that inflation stays close to its objective. It's not enough, of course, to have an objective. The Federal Reserve must also communicate that objective clearly and credibly. It's that communication that serves to anchor the public's medium-term and long-term inflationary expectations. Put another way, if the FOMC does not clearly communicate its objectives, the public can only guess at what it intends. And inflationary expectations and inflation itself inevitably will end up fluctuating, and perhaps by a lot. It is possible to undo these shifts in expectations, but only at significant economic cost. And the nation saw this all too clearly in the early 1980s, when tighter monetary policy, necessary to rein in high inflation, resulted in painful employment losses. And this theme is one I'm going to return to later. The idea that to bring inflation expectations back into check from their upward drift, you would have to incur painful employment losses. This is a theme that I will touch on in my future remarks. Now, the Federal Reserve communicates its objective for inflation in a number of ways. For example, quarterly intervals, FOMC meeting participants publicly reveal their forecasts for inflation in the longer run, interpreted usually as maybe 5 or 6 years, under the assumption that monetary policy is optimal. And these forecasts usually range between 1.5% to 2% per year. So they're often collectively referred to by saying that the Federal Reserve views inflation as being mandate consistent if it's running at 2% or a bit under. That's the price stability mandate. As I mentioned, Congress has also mandated that the FOMC set monetary policy so as to promote maximum employment. Now, some see an intrinsic conflict between the FOMC's price stability mandate and the maximum employment mandate. But there is actually a deep sense in which the two mandates are intertwined. Imagine that inflation were to run at 3 or 4% per year for 3 or 4 years. At that point, the public will then start to doubt the credibility of the FOMC's commitment to a 2% or a bit under objective. What will happen is the public's medium-term inflation expectations will inevitably start to rise. And again, I return to my point that as we saw in the latter part of the 1970s, these changes in expectations can serve to reinforce and augment the upward drift in inflation. And at that point, the Federal Reserve will have to tighten policy considerably if it wishes to regain control of inflation. And as I mentioned before, as we saw in the early 1980s, it's this tightening, if it becomes necessary, will generate large losses in employment. In other words, failing to meet its price stability mandate can also lead the FOMC over the medium and long term to substantial failures on its employment mandate. Now, I've talked about how the price stability mandate is usually translated as 2% or a bit under inflation measure. An important ongoing communication challenge for the FOMC is it is much harder to quantify the maximum employment mandate. Changes in minimum wage policy, demography, taxes and regulation, technological productivity, job market efficiency, unemployment insurance benefits, entrepreneurial credit access, and social norms. And I could go on, actually. All of these influence what we consider as maximum employment. And you would not want to try to offset any of these changes in the economy with monetary policy, because doing so would lead to a dangerous drift in inflation or expectations and ultimately in inflation itself. Now, over the past year, the FOMC has communicated through its statements that it perceives the current unemployment rate to be elevated relative to the levels that it views as consistent with its dual mandate. Now, in this situation, there is a trade-off in the making of monetary policy. On the one hand, adding accommodation, monetary accommodation, reduces unemployment. On the other hand, adding accommodation increases the risk of generating inflation markedly higher than the committee's objective of 2% for a significant period of time. In choosing whether to add monetary stimulus or not, the committee must resolve this trade-off between the fall in unemployment and the increase in the risk of inflation. Now, I've described the relevant trade-off in a very traditional way as being between employment gains and inflation risks. This description emphasizes the tension between the two mandates. But as I explained earlier, if the public observes inflation running at 2%, more than 2% for multiple years, their expectations about inflation may drift upwards. And again, this increase in expectations may give rise to a need for monetary tightening that may generate large employment losses. In other words, when adding monetary accommodation, the Federal Reserve confronts a basic trade-off that can actually be framed without reference to its price stability mandate at all. It's a trade-off between short-term employment gains and the risk of larger long-term employment losses. So I've been talking about the objectives. I've talked about the FOMC's dual mandate, which is to keep inflation at 2% or a bit under and promoting maximum employment, which is generally interpreted as trying to keep unemployment low. But how does the FOMC make its choices at each meeting so as to achieve these goals? I believe that it's useful to think of a driver who's trying to maintain a car speed. To do so, he'll vary pressure on the accelerator in response to changes in road conditions, current and expected, hills, valleys, rough pavement, headwinds. And in the same way, the FOMC varies its chosen level of monetary accommodation in response to changes in current and expected economic conditions. So this kind of systematic response to changing economic conditions is an essential part of good monetary policy for at least two reasons. First, there's a good deal of theoretical support and empirical evidence for the idea that following a policy rule, as economists call it, is what enables the committee to actually achieve its dual mandate goals. Second, and perhaps more importantly, actions speak louder than words. The committee can claim that it intends to make monetary policy so as to fulfill its dual mandate. The public can and does watch its actions carefully in this regard. If the committee fails to reduce what is an immense amount of accommodation right now in a timely fashion, the public may well begin to doubt the committee's claims about its goals. I made reference to the immense amount of accommodation. Here's what I'm talking about. Right now, the Federal Reserve has multiple forms of accommodative monetary policy in place. The FOMC is targeting a Fed funds rate between 0 and 25 basis points. It's targeting a Fed funds rate between 0 and 25 basis points, which is between 0% and 0.25%. This kind of accommodation, keeping short-term interest rates extremely low, is an entirely conventional response to the current situation. By keeping market interest rates low, the policy encourages households to spend more, and it encourages companies to invest in hiring and business expansion. The committee has also announced that it anticipates that conditions will be such that the Fed funds rate will stay this low for at least 20 more months. Now, the second kind of accommodation is less conventional. The Fed has bought over $2 trillion of longer-term government securities and has announced its intention to buy still more. The goal of this form of accommodation is to raise the prices of longer-term securities and lower longer-term yields. In so doing, more long-term investments, like building factories or hiring workers, become attractive to businesses. Now, this combined package of accommodation is really unprecedented. As I've described at length in earlier speeches, I believe that it has been critical in keeping inflation from falling lower and unemployment from rising higher. But as economic conditions improve, the FOMC will need to reduce the amount of accommodation that it is providing. Now, what conditions are relevant here? Again, I like to think of a car driver who's trying to maintain his speed. The driver, to know how much or little acceleration to provide, the driver would like to know his current speed, as well as would like to know how future road conditions are likely to affect his speed. The FOMC's problem is quite similar. Just like the driver needs to know his current speed, the FOMC needs an accurate measure of current inflation and unemployment. Just as the driver needs an estimate of his future speed based on anticipated road conditions, the FOMC should have an assessment of the future levels of inflation and unemployment. So I find it helpful to summarize the relevant information in what I term a mandate dashboard. So for reasons that will become clear later in my remarks, I think it's useful to start by looking at the dashboard from a year ago, early November 2010. So this is what I call a mandate dashboard. And I'll explain the dashboard starting from the inflation side. That's from the left. The first cell from the left is current inflation. Current, by current, of course, I mean as of November 2010. The second cell is what inflation is projected to be in 1 year's time. And the third cell contains a forecast for inflation in 2 years' time. So this is moving from the left to 10, 13, 13. The unemployment side is similar. The first cell from the left represents current unemployment. The second cell represents a forecast for unemployment, and the third cell in 1 year's time, and the third cell unemployment in 2 years' time. Now, of course, I have to be a little more precise than just using these words inflation and unemployment. And by inflation, I mean the change in the personal consumption expenditure, PCE, price index, over the preceding 4 quarters, excluding changes in the prices of food and energy. So I'm using core inflation. By unemployment, I mean the unemployment rate averaged over the 3 months in the current quarter. Now, by the forecasts here, where did I get these forecasts? These are actually the committee's own forecasts. They're the midpoints of the central tendencies of the projections of FOMC participants that they released in November 2010. Now, the FOMC should vary the level of monetary accommodation in responses to changes in the mandate dashboard that you see before you. How to do that quantitatively is going to depend on the price movements of the 6 variables and on how the FOMC resolves a trade-off that I mentioned earlier between inflation risks and unemployment reductions. But the qualitative direction of the response is typically easier to determine. So the November 2010 dashboard shows that the FOMC expected the unemployment rate to fall over time slowly, from 9.6 to 9.0 and then on to 8.0, and the inflation rate to rise slightly. As that happens, the FOMC should respond by slowly, and I emphasize slowly here, lowering its immense level of monetary accommodation. Okay, so that's by responding to this mandate dashboard, the FOMC can make policy in an effective fashion to achieve its dual mandate. Now, why did I pick November 2010? I picked it because at that point in time, the FOMC chose to add considerably to the level of monetary policy accommodation. It undertook the purchase of $600 billion of long-term treasuries over the next 8 months in what was called QE2, quantitative easing 2. I supported this action within the meeting and then later publicly. And then the committee took no further significant policy action until the last two meetings in August and September of 2011, at which point it added considerably to the accommodation that it had in place. Now, I dissented from these decisions of these last two meetings. My thinking behind these dissents was grounded in the evolution of exactly this mandate dashboard over the past year. So this is the evolution of the dashboard over the past year. And the entries from November 2010 are exactly what I've already shown you. And they're based on the FOMC's economic projections. Now, I would like to have been able to use projections from the FOMC to construct my October 2011 dashboard, but I can't do that. The FOMC's most recent projections date back to June, and so the entries for October are actually based on my own forecasts. The fourth quarter is not yet complete, but it looks like fourth quarter over fourth quarter PCE core inflation in 2011 will be around 1.9%. Remember that number? Well, you don't have to remember. It's right there. It was 1.0 in November 2010. They expect it to rise over the next couple of years to slightly above 2%. At the same time, unemployment is 9.1%. I expect it to fall slowly to 8% by the end of 2013. Now, in fairness, I should say the private sector forecasts for inflation are probably closer to 1.6% than 2.1. So the 1.9, I think a lot of people would agree on that. The 2.1s, many private sector forecasters would say those are going to look like 1.6 instead. One thing to notice here, the second cell for November 2010 is the forecast for inflation over the course of 2011, whereas the second cell for October 2011 is the forecast over 2012. This is because monetary policy operates with a 1 or 2 year lag, so you always look 1 or 2 years ahead. So, regardless of whether you look at my forecasts, which are up there, or the private sector forecasts, inflation and the outlook for inflation have risen markedly since last November. Unemployment and the outlook for unemployment has fallen. These changes in the mandate dashboard suggest that the committee should have lowered the level of monetary accommodation over the course of the past year. Instead, the committee chose to raise the level of monetary accommodation. The committee's actions in the last two meetings were thus inconsistent with the evolution of the economy in 2011. And it's this inconsistency between the committee's actions and the evolution of the economy, as shown in the mandate dashboard, that led me to dissent in August and September. I want to be clear about one important point. Like many private sector forecasters, the FOMC has overestimated the strength of the recovery over the past 2 years. And some have suggested that this unexpected slowness in the recovery is a justification for increasing the level of monetary accommodation. But I disagree with this argument. I've just described why the FOMC should respond to improvements in economic conditions and outlook with a reduction in the level of monetary accommodation. Logically, if the economy recovers much more slowly than expected, then the FOMC can respond by reducing the level of monetary accommodation, but much more slowly than expected. The FOMC should only increase monetary accommodation if the economy's performance and outlook relative to the dual mandate actually worsens over time. Okay, so I've violated Lauren's ground rules, but I'm coming to the close here. So let me wrap up with some final thoughts about 2011. I'll look ahead to 2012. So earlier in my speech, I set forth what I see as a key trade-off involved in the making of monetary policy. There is a benefit to adding monetary accommodation. It reduces unemployment. There is a cost to adding monetary accommodation. It increases the risk of inflation, running above the committee's objective of 2% for multiple years. The committee's actions in 2011 suggest the FOMC is resolving this key benefit-cost trade-off differently in 2011 from however it viewed that trade-off in 2010. It appears that the committee is now more tolerant of the risk of higher than 2% inflation than it was in 2010. Moreover, as I explained earlier, one can reframe this trade-off in a way that is entirely separate from the price stability mandate. Higher than 2% inflation over multiple years might lead to an upward drift in inflationary expectations. And the Fed found in the 1970s that this upward drift could only be retarded by large, medium, and long-term employment losses. So I see the basic unemployment-inflation trade-off as really being about short-term employment gains and the risk of larger long-term employment losses. And the FOMC's actions in 2011 suggest that it's resolving this trade-off differently from however it viewed that trade-off in 2010. The FOMC seems to be putting more weight on the short term and less on the long term. Now, I want to be very clear here. I don't view the current resolution of this trade-off as being intrinsically problematic. Nor, in 2010, did I view that resolution of the trade-off as intrinsically problematic. What I do see as problematic is that the resolution of this trade-off seems to be changing over time. In particular, the committee's actions in 2011 suggest it is more willing to tolerate inflation risks and the concomitant medium-term and long-term employment losses than it was in 2010. If this drift in inflation risk tolerance were to persist, or were expected to persist, it could give rise to a damaging increase in inflationary expectations. And it's exactly in this sense that I have said in earlier speeches that the committee's actions in 2011 served to weaken the committee's credibility. Enough about the past, though. What about the future? So I believe the FOMC's decision-making in 2011 has introduced a lack of clarity about how it views its monetary policy mission. I believe this lack of clarity can and should be addressed in two ways. First, the FOMC should explain how it plans to resolve the trade-off between inflation and unemployment in making its future decisions. Second, on an ongoing basis, the committee should provide explicit communication about how its chosen actions are indeed consistent with this pre-announced resolution of the inflation-unemployment trade-off. Here, I believe that the use of metrics like the mandate dashboard provides a useful form of discipline, both on the committee's own actions and then in the public's understanding of these actions. So last May, Chairman Bernanke gave a speech in which he said, transparency regarding monetary policy not only helps central banks make central banks more accountable, it also increases the effectiveness of policy. I agree completely with this sentiment. And I see my two recommended steps for the future: clearer communications about trade-offs and the explicit use of metrics like the mandate dashboard is promoting exactly the kind of transparency that Chairman Bernanke was describing. Thank you for listening, and I look forward to taking your questions.